Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 19th of June, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. RBA monetary statement from yesterday highlights. Well, as we all know, overnight rates remain the same at 4.35%. Inflation is getting better, however, it is slower than desired in terms of its decrease now. It's premature to cut rates because overall demand is still strong, even though per person consumption in the household is negative growth. Markets are strong due to overall there's fine growth. Here are a few important charts that are worth keeping. This chart is 1 year forward PE of developed markets and emerging markets. And then the yellow line or orange line is Van Eck Emerging Market Index. I would look at the dark blue and the light blue for most purposes. This chart is price to book of developed markets and emerging markets over time. And this is very important for Australia. This is resource stocks and bank stocks performing versus the ASX 200. As you can see that resource stocks have been underperforming and bank stocks have been outperforming. So what does this tell you? Now, it doesn't mean that banks will continue to outperform. It just means banks have had an amazing run and now they're dramatically overpriced. Here is historical resources PE and return on equity numbers. This chart's also fascinating. It's worth keeping. This chart is historical bank PE and return on equity. What you see is banks are at a historically high PE right now, which I've covered previously, and return on equity is pretty mediocre. Historical bank net interest margin is the bottom chart. Well, as you can see, it's been continually going down. Net interest margin is the spread between what the bank lends money out at and what the bank receives. Thus, as NIM declines, that means profitability of banks declines. The only way to continue being profitable with some growth is to continue to grow your outstanding loans. Even that's becoming difficult these days for the majors. This chart shows cash as a percent of assets under management. Well, it's kind of interesting, but what it tells us right now is that the amount of cash outstanding is pretty much normal. It's right at the mean. 3 companies that I saw this week that I wanted to share. First is Steadfast Group, and the code is SDF. The price right now is about $5.66. As you can see with this 5-year chart, it's been nothing but up, but lately it's been kind of peaking. However, let's look at the numbers to see will it continue going up. These numbers, by the way, are estimates from Barrenjoey. The market cap right now is $6.2 billion. And the price target Barrenjoey shows is $6.85. Revenue growth from 2023 to 2026 each year is at 14%. Earnings per share growth in this period is 11% per annum, and the dividend growth is around the same at 12% per annum. These are solid numbers. They're not outstanding. However, these are solid and consistent. The PE on 2025 earnings estimate of 30.4 cents is only 18.6 times. And the yield on the 2025 dividend estimate of 19.6 cents is 3.5%. These are also decent numbers. Free cash flow is around 7.5%, and the PEG is 1.66. Well, as I've covered previously, PEG over 1 is not all that attractive. However, when you have a company that has decent growth and is steady, it's okay to pay a little bit extra because you're really paying going further out for the long term. The payout ratio for Steadfast is 75%. Now, who is Steadfast? They happen to be the largest general insurance broking network in Australia by premiums and number of brokers. That's who they are. I would rate them a buy at half weight. Second company I've covered before is ASX Limited. You know, the ones that run the stock exchange. The code is ASX, obviously, and it's trading right now at about $57.90. This chart tells you everything you need to know. It was trading 90 to around 100 and has plummeted dramatically. It tried to rally, But as they come out with new results, new updates, it just starts going down again. What is going on here? Well, right now it has a market cap of 11 billion. 12-month price target, this is an average of like 8 major brokers that I calculated. It's 59.20. Brokers like UBS are 55, Morgan Stanley is 54.65. A lot of other brokers are at 60 or 61. Nobody's at a really high level, except Morningstar does have an analyst who is very bullish on ASX, and I think he's got a price target in the 70s of somewhere between 72 and 75. He's a statistical stray. I'm not saying he's wrong, but he's just being very bullish. Revenue growth from 2023 to 2026 is 4.6%. This is a little bit of an uptick. It's still not all that great, considering where inflation is, but it's still better than it has been. The earnings per share growth estimate from 2023 to 2026 is only about 1.9% per annum, and the dividend growth rate in this period is less than 1% per annum. The PE on ASX's 2025 earnings estimate is $2.63. This is really an average of 2025 estimate and 2026 estimate to get me that 263. That's a PE of 22 times. That's lower than it has been, but that's because the stock price has dropped. The yield on the 2025 dividend estimate is $2.24. This is also an average of 25 and 26 estimates. The yield is 3.85%. This is what's keeping the stock up, I believe. Free cash flow is 4%. Payout ratio is 85%. This is very high. However, historically it's been at 90%, and they've lowered it a little bit because they have extra CapEx. Personally, I think they have more CapEx that they have to spend to get up to speed. ASX operates Australia's primary exchange for shares, derivatives, along with the clearing and settlement, which includes for fixed income. I rate it neutral because the price has now dropped. I can see it dropping down in the low 50s, but if it does, then it probably is a buy at that level because it does have a quasi-monopoly and it is fairly steady. It's just that it's very, very slow. They can be performing much better than they are. This company, I saw 2 research reports this week and I go, who are they? I've never heard of them before. Light and Wonder. The code on the ASX is LNW and it trades for $148.39. This is a chart. It's only been trading for a couple of years, but it has a good track record so far. Looking at the numbers, these are from Jardine and Morgan's. The market cap is $13 billion. Price target, respectively, was $166 and $172. These are discounted cash flow basis price targets. The revenue growth in each of the next 3 years is 7% per annum. That's okay, it's not great. However, the earnings per share growth from 2023 to 2026 is 55% per annum. That's outstanding. It doesn't pay a dividend. It's growth stock, that's fine. As a consequence, I look at the shareholder equity growth rate in this period, and that's 19% per annum. So it's not huge like the earnings per share growth, but it is very strong growth rate for shareholders. Now, what is driving this earnings per share growth? One of them is that they bought back about $750 million worth of shares. Now they're going to buy back another $1 billion worth of shares. So when you look at PE, it's the price over earnings, and then you want to manipulate the earnings per share, well, you reduce the denominator. So if you have fewer shares outstanding, you then have a higher earnings per share, which gives you better ratios. The PE on the 2025 earnings estimate of $8.40 is 17.7 times. So for a company with this kind of growth, that's not that high PE. Has no yield. Free cash flow is $1 billion a year. That's extraordinary. They develop global gaming content, hardware, and technology solutions for land-based and digital customers and players around the world. I rated a buy half weight. The reason I'm half weight is because gaming is, there's an ESG, there's an ethical thing here. I happen to like Aristocrat, But when you get into computer gaming and kids and people getting addicted, I'm not so positive about those type of things. But on a fundamental basis, this is a decent buy. But also when things are online and in technology, things can change quickly. So I rate it just a half weight. As always, you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Have a great week, and I hope you make money. Thank you.